Given the current level of market volatility and uncertainty, how are you positioning the portfolio at the moment?
The recent volatility has really given us a chance to focus on the highest quality issuers in the marketplace. We've taken a more defensive stance. So we've come back to the names we know really intimately, names we know well, and names which have little or no direct exposure to peripheral European sovereigns at all. We're also taking a higher weighting in cash, running at about 20 to 25% right now, which is giving us a chance to opportunistically pick up assets as they fall in price, and also providing a good buffer against some of the more volatile names in the marketplace.
And Josh, just wanted to add one more point that back in October we had some investments in AXA, which was a high quality insurance company, but given what was happening in the market, and in particular I guess what was happening in French bonds, we felt it was more prudent to cut that position and actually be a little bit more defensive and not be exposed to the French market.
It's true, whilst we had no concerns at all with regard to AXA's creditworthiness, it was simply that some of the volatility we're seeing in some of the French banks, such as BNP and SocGen, gave us concern about the possible volatility of this particular security, so we decided to remove our weighting towards it.
The Reserve Bank has cut the official cash rate by 0.25% at its last two meetings, making the returns on term deposits less attractive for investors. Do you see this trend as continuing, and what would the impact be on our portfolio?
In our view, as you rightly pointed out, RBA has moved twice already. Moving forward, I think they will be a lot more cautious, a lot more measured, and they'll balance between, I guess, domestic risk as well as international risk in terms of how aggressive or how cautious they cut interest rates.
From a portfolio perspective, our base case is to run with 50% fixed and 50% floating in the portfolio, so that we shouldn't benefit too much from a rate cut nor from increasing interest rates as well. Whilst interest rates have fallen, we're still managing to find securities and lock in returns in the realm of 8 to 12%, which we've targeted and are still finding on an ongoing forward-looking basis. And from an ongoing perspective, further down the track, there's still a lot of concern about inflation and what the impact of quantitative easing could have on inflation and interest rates further down the track. From that perspective, the amount of floating we have in the portfolio should also give us a degree of buffer and security against a rising interest rate environment as well as falling interest rates with the fixed portion we have.
If the situation in Europe were to worsen, perhaps leading to a breakup of the euro, what impact do you think that would have on our portfolio?
There's no doubt that greater volatility and a deterioration of events in Europe would have and could have a relatively marked impact upon the pricing of some of the securities we own. But it's important to remember that the securities we own are issued by the likes of Commonwealth Bank, Rabobank, National Australia Bank, and other well-known household names of which we have the greatest confidence in their creditworthiness. So even if we saw their prices decline due to some volatility in financial markets, as long as these companies maintain their creditworthiness and manage to survive the period, and we're confident they will because they have no direct exposure to the peripheral sovereigns in Europe, then the returns we've locked in now are locked in from now until the call date of the securities.
If we take a more positive outlook towards Europe and form the view that they'll be able to resolve their issues, how do you think that will play out in terms of our portfolio?
I think being so cashed up over the last 6 months has really helped our cause. We've been opportunistic buying in the down markets, so should Europe resolve itself, we should expect the purchase that we've made to rally in price, and you should see some positive returns come through from our opportunistic buying. Likewise, our portfolio as a whole should get marked upwards, as some of the stocks have been hit a little bit over the last 6 months.
And there's no doubt our securities are lower beta, lower risk than equities, so you don't expect them to rise as much as equities in a bull market, and consequently you don't expect them to fall as much as equities in a bear market. And we've seen that recently with the credit fund and holding up much better than global equity markets. And indeed, in a bull market, you would expect that our prices would be marked upwards and our returns would be rising in line with global equity markets, but not to the same extent, obviously. And having the extra cash position has indeed, as you mentioned, allowed us to buy some securities at very attractive prices, and we'd expect to see some significant price improvement from those.
Tell us a little of what you do in assessing the quality of each credit in the portfolio and the nature of the documentation that you have to go through for each investment?
In any investment we do a very thorough credit review. And in particular, we focus a lot on the downside. Once we've done a credit review paper, which could be 20 to 30 pages long, we present it to the investment committee, who then go through it thoroughly and question us. And they will not accept a credit paper without very thorough questioning. And after investment committee meetings, we tend to get questions asked by the committee members, which we then go back, do some more work, and then represent to the committee members. And only when they are happy with what we've presented that we do purchase the securities that we proposed.
The process really starts at the basics. We go back to the annual reports. We look at the last 5 years' annual reports. We go right through the balance sheets, through the P&L. We look at the key ratios, and we get on the phone. And importantly, we call the debt investor relations people offshore. We call the CFO where possible, and even have meetings with the CFOs of some of these companies. Even of some of the large banks, even debt investors, relatively small debt investors such as ourselves in Australia, do sometimes get access to the CFOs. We make sure we go through that process. And then most importantly, what's unusual about the hybrid market and the bond market that may not be familiar to share investors is that each individual bond is unique in its own right. Many share investors think when they buy a Commonwealth Bank share, any Commonwealth Bank share all ranks equivalent. They all rank pari passu with the same rights and responsibilities. The same's not the same in the bond market. Every bond is individual, has different covenants, different responsibilities and different rights that a bondholder has, even coming down to the domicile in which it was issued in. What we do is we get the legal documentation and prospectus for every single security that we invest in. We do a thorough review of it, and we also send it off to a third-party independent lawyer for a legal review, and we also get it reviewed from an accounting perspective as well. So not only from a tax perspective and from a legal perspective and a credit perspective, we go through the securities from all angles to make sure we understand all facets of the securities, all the risks, all the downsides, and make sure that it really is the best security we can find with the best return.
We have discussed the attractive returns in offshore markets in these types of securities. What's to stop an investor just going out and trying to secure the investments himself?
It's a fair question. And reality is the investors probably, to some extent, could, but there's real challenges that they would face in terms of hedging the currency risk and also accessing the market in terms of the size. For many of the investments we look at, you need to buy minimum parcel sizes of $500,000 or $1 million at a time. And indeed, access to these securities is difficult as well. Many of the securities we try to invest in, and we do invest in, are very illiquid in the sense that they are tradable and tradable in large parcels, but they're not immediately available to the average investor. The securities we trade in what's called the over-the-counter market. There's no listed exchange, so one can't simply jump onto a ComSec or an ASX listed internet interface to buy some of these securities. You actually need to know who to call and who's going to have the bonds and how to access them. So what we've done is establish this network of participants in the market who we have good relationships with. They know which bonds we're interested in, and so they give us a call when they're available. And most importantly, then from a currency risk perspective as well. Many of the securities we invest in are denominated in US dollars, in sterling or euros. The currency risk can mitigate a lot of the positive returns that an average private investor might seek to achieve. What we actually do is hedge all of them back into Australian dollars and eliminate all the currency risk. So that when we buy a security, we actually lock in Australian dollar returns from now right through to the maturity of the bond, so we eliminate all the currency risk.
Can I also add that the importance of access to the market, and this is where Josh's experience offshore, being in New York, being in Tokyo, having those contacts in those markets makes such a big difference, especially in a market where there's not a lot of liquidity. Knowing where to go and who to talk to is very important. And we've noticed over the last 6 months, as liquidity dries up, there is a difference in pricing, and you want to be there for the right person, with the right person at the right time.
Yeah, it's very much about access. There can at a time be only maybe 2 or 3 million of a particular security that's available for purchase. And unless you get the first call and the right call to buy those securities, you'll miss out on the opportunity.
What sort of opportunities is the current market volatility creating for investors and for the fund generally.
Being so cashed up, it's been a fantastic position to be. We've been able to pick up some strong Australian banks such as ANZ and NAB and pick up yields which are in the 13 to 16% mark.
Yeah, there's certainly been some opportunities that have been thrown up. Some securities we were looking at as recently as 6 months ago, providing returns of around 8 to 9%. It didn't fall into our hurdle category, and now providing returns upwards of 13-14%. One particular National Australia Bank security, which is denominated in sterling, we've been purchasing over the last month or so for our investors. As recently as April, it was trading at a cash price of around 96.98. Has now fallen down to around 82. We've been able to buy it at 82 for our investors. At 96 or 98 in April, providing only a return of 9 or 10%, we didn't feel was adequate, given the risk of the security, despite the fact it is issued by National Australia Bank and a low-risk security. But now providing returns of 13, upwards of 13 to 14% gross returns for our investors, it looks very attractive. So the volatility, whilst it can create some short-term price falls on some of the existing assets, it's also providing some great opportunities for our investors on a long-term basis.